Welcome to the deep dive. This is where we take interesting sources, things you might be curious about, and really pull out the key insights for you.
Think of it as getting you seriously well informed, but without having to wade through dense academic stuff.
Exactly. And today we're diving into some really fascinating territory. We've got excerpts from Matthew Klein's book, Trade Wars Are Class Wars.
hmm
Yeah.
And we're going to unpack this, well, maybe surprising link between the trade disputes we hear about between countries and the inequality that's happening within those same countries.
Yeah, it's a perspective shift, isn't it? You usually think of trade wars as, nations going head to head on the global stage.
Right. Big geopolitical stuff.
But this dive suggests, well, a lot of that tension actually starts at home. It's driven by internal economic dynamics.
And we think digging into this will offer some real aha moments, connecting things from history to what's in the news right now.
Our aim is really just to help make sense of these complex global issues, but keep it clear and accessible. No getting bogged down.
And Klein's book is a great guide for this. It looks at the whole sweep of global trade and finance history.
Arguing, essentially, that rising inequality inside nations is the main thing fueling trade conflicts between them.
Yeah, it's a really compelling argument. He draws on economic history, from Adam Smith right up to the present day, like the U.S.-China trade relationship.
Okay, so let's get right into that central argument then. What's the absolute core idea Klein puts forward?
The core thesis is pretty straightforward, but powerful. Rising inequality within countries acts as a primary driver of trade conflicts between them.
So the imbalance inside somehow pushes outwards.
Exactly. And what's quite interesting, maybe even a bit optimistic, is the implication that these conflicts aren't just, inevitable geopolitical destiny.
Okay.
They stem from these internal economic imbalances, which theoretically means they could be addressed through internal policy changes, not just international treaties.
That's a key point. These internal decisions, often driven by how wealth is concentrated.
They directly cause the international imbalance.
And he uses examples like China and Germany to show this.
Precisely. He argues their economic policies, which are themselves shaped by domestic wealth concentration, are major contributors to global trade imbalances.
How so? Like Chinese underconsumption.
Yeah, that's one example. The idea is that because wealth isn't widely distributed, overall domestic demand in China is lower than it might be. They produce more than they consume domestically.
So they export the difference. Makes sense.
And then there's the German example, things like wage suppression or really stagnation. Various policies and economic structures have kept wage growth relatively flat for a long time.
Meaning German workers have less disposable income.
Right. Less spending power, which again contributes to Germany running these huge trade surpluses. It's about internal factors having these big international consequences.
That really reframes the issue. Now, the book goes back in time, too, looking at early trade theories. Can you unpack that a bit?
Yeah, it's helpful context. There's this contrast between the early arguments for free trade, people like Adam Smith and David Ricardo in Britain.
The classical economists.
Right. And then the American system, pushed by figures like Alexander Hamilton and later Friedrich List, these were quite different blueprints for trade.
Okay, so Smith and Ricardo, their case for free trade was based on
Comparative advantage, mostly. If each country specializes in what it does best or most efficiently, and then they all trade freely,
everyone benefits overall.
that was the core idea. But it's crucial to remember the context. They were writing at a time when technology limited how much production could be fragmented across borders. Complex global supply chains weren't really a thing yet.
So production was more localized.
Much more. And Ricardo also made a key assumption about capital mobility. He figured investors would generally prefer to keep their money closer to home, due to risk and difficulty overseeing foreign investments.
Which seems logical for that era, with limited communication and travel. Okay, so what about the American system? Sounds different.
It was fundamentally different. Hamilton, as the first U.S. Treasury Secretary, and later Friedrich List, who was influenced by the U.S. model, argued for protecting nascent or infant industries.
Protecting them how? Tariffs.
Tariffs, yes, taxes on imports, and also subsidies, basically government support for domestic businesses. Hamilton believed this intervention was vital to nurture American manufacturing.
Why? To compete with Europe.
Exactly. To reduce dependence on established European powers and build up the U.S.'s own industrial base. He felt the government had to actively create the right conditions for that.
So not immediate free trade, but a more strategic approach.
You could say that. It was about building national capacity first.
And Friedrich List built on this.
He did. He developed this idea of the national system, really emphasizing the link between a nation's economic strength and its overall power. He saw the U.S. as a kind of model for Germany, which wasn't unified yet.
So he was critical of just pure free trade theory.
Yeah, he thought it didn't fully account for the reality of competing nations or the importance of national industrial development. These early debates really laid down tracks we're still following in some ways.
Fascinating. Okay, fast forward to the interwar period between World War I and II. What happened to global trade then?
Oh, that was a period of massive disruption. World War I wrecked European economies, and then the Great Depression hit.
Oh, double whammy.
Absolutely. And trade just collapsed. A big factor was the Smoot-Hawley Tariff Act in the U.S. in 1930. Very high tariffs on imports.
Which led to retaliation.
Exactly. Other countries put up their own tariffs, and global commerce just spiraled downwards. It was a disaster for trade.
A huge shock.
Yeah. But interestingly, the book notes a kind of paradoxical side effect. Within many wealthy countries, this period actually saw greater income equality, temporarily.
Really?
Partly through the destruction of old wealth during the wars and depression, and also some government redistribution policies during that era. A strange outcome from such a dark time.
Okay, now jumping ahead again. How did trade really transform later in the 20th century? What were the big drivers?
Two huge technological shifts, really. First, container shipping. Those standardized metal boxes fundamentally changed the cost and speed of moving goods.
Just revolutionized logistics, didn't it?
Completely. And second, huge leaps in communication technology. Faster, cheaper communication made it possible for companies to manage production processes spread across the globe.
So that enabled these complex supply chains.
Precisely. Companies could break down manufacturing, doing different bits in different countries to optimize costs or access specific skills. This is the rise of global value chains, or GVCs.
Where one product has parts and labor from many different places.
Exactly. And this messes with how we read trade data. The traditional stats, just counting the total value of goods crossing a border, don't really show where the value is actually added.
Can you give an example?
Sure. Think of an iPhone assembled in China. It counts as a Chinese export at its full value. But a huge chunk of that value comes from design in the U.S. Chips from Taiwan, maybe screens from Korea. China's value added might just be the final assembly.
So the headline trade figures can be misleading.
Very misleading.
Yeah.
The book estimates that for the U.S., both imports and exports are probably overstated by something like 16 to 20% if you account for GVCs. For China, it could be around 30% overstated.
Wow. That's significant. And tax havens complicate this further.
They do. You have countries like Ireland, the Netherlands, Luxembourg, with low corporate tax rates. Multinationals find it attractive to legally book their profits there, even if the actual work, the R&D, the sales happens elsewhere.
Like Apple or Microsoft routing profits through Ireland.
Exactly. It's called profit shifting. And it further distorts the trade and financial statistics, making it look like huge profits are generated in these small, low-tax places. It adds another layer of, well, complexity to figuring out what's really going on.
Definitely a tangled web. Okay, let's shift to financial crises and these trade imbalances. The book sees historical patterns here.
It does. Klein points out these recurring cycles booms in international lending, followed by busts and financial pain. He mentions things like lending to the U.S. back in the 1830s or the Panic of 1873.
So big cross-border capital flows aren't new.
Not at all. And neither is the potential for instability when borrowers can't repay. This connects directly to trade imbalances through a basic economic identity. Exports minus imports always equals domestic saving minus domestic investment.
Okay, run that by me again. Exports minus imports.
Equals saving minus investment. So if a country saves more than it invests domestically, that excess saving has to go somewhere. Often it flows abroad, financing other countries' spending. That leads to a trade surplus for the saving country.
And the flip side, if you invest more than you save.
You need to borrow the difference from abroad, which means running a trade deficit.
Got it. So imbalances aren't automatically bad.
Not necessarily. They can be good. Think about capital flowing from rich countries to developing nations that need investment for infrastructure or industry. That can fuel growth.
But problems arise when?
Problems arise when the imbalances are driven by, say, insufficient demand in the surplus countries. So their excess production just flows out and displaces production in the deficit countries, rather than financing useful new investment there.
And the book talks about a high savings model of development. What's that?
It's a strategy where a country deliberately holds down consumption to maximize savings and channel those savings into investment building, factories, infrastructure, etc. The goal is rapid industrialization and future growth, even if it means people consume less now.
Like the Soviet Union or maybe post-war Japan.
Those are often cited as examples, yeah. It involves trade-offs, certainly, potentially lower living standards for a time in exchange for faster capital accumulation.
And how do corporate surpluses fit in? Companies holding lots of cash.
In many developed economies today, yeah, corporations are sitting on large piles of cash. They're earning more than they're choosing to reinvest in their own domestic operations.
Why? Lack of good opportunities.
That seems to be a big part of it, a perceived lack of compelling domestic investment projects. So this contributes to the global pool of savings, looking for a home, potentially flowing abroad and adding to these imbalances.
Right. Okay, let's zoom in on those surplus countries the book focuses on. Germany and China. Starting with Germany. What's their story?
Germany's situation is really interesting. The book argues reunification back in 1990 was a key factor, integrating the less developed East German economy.
And the threat of companies moving production east?
Exactly. That put downward pressure on wages in the West. Wage growth stayed pretty sluggish for a long time.
Which helped keep German goods competitive for export.
Right. And it also restrained domestic consumption. Then you add policies like the Schuldenbremse, the debt brake.
The constitutional limit on government debt.
Yeah. While it aims for fiscal prudence, it also limits the government's ability to boost domestic demand through, say, major public investment programs.
And wealth distribution within Germany matters too.
It does. Germany is actually quite unequal in terms of wealth distribution, more so than people might think. Median household wealth is surprisingly low compared to some neighbors.
And wealthier people tend to save more.
Generally, yes. So high wealth inequality can also dampen overall domestic spending. Before the 2008 crisis, Germany's surplus was essentially financing spending booms in other Eurozone countries, like Spain or Ireland.
So Germany was lending its surplus savings to its neighbors, in effect.
Through the mechanics of the Eurozone, yes. So
Right.
its internal situation had huge external effects.
Okay, now China. Different system, but also a massive surplus. What drives that?
China's case is very tied to its state-directed economic model. The book points to several things. Suppressing labor rights, which keeps wages down. The Hu-Ku household registration system, which limits migrants' access to social services in cities, discouraging spending.
And financial repression.
Yeah, meaning the banking system is geared towards funneling cheap credit to state-favored industries and investments rather than maximizing returns for household savers or lending for consumption.
So a whole suite of policies tilted towards investment over consumption.
Historically, very much so. Prioritizing building capacity, factories, roads, cities, over boosting immediate household spending. This obviously creates enormous productive capacity, much of which ends up exported.
The book mentions data issues, too.
Yes, some inconsistencies, particularly around services trade like tourism spending, suggesting the official surplus figures might even be slightly inflated sometimes. And crucially, China's growth has been super reliant on debt-fueled investment. That model has limits.
It seems like both Germany and China, though different, have these internal dynamics creating massive external surpluses. Okay, let's flip to the deficit side of the U.S. Is it all about U.S. government spending?
Well, that's the common narrative, right? Big government deficits drive the trade deficit. But the book argues it's more complicated. It looks at the private sector's balanced household and corporate saving versus investment.
And that fluctuates.
It does. There have been times the government deficit shrank, but the trade deficit didn't follow suit because private borrowing picked up, for example. The link isn't always one-to-one.
So what about foreign money flowing into the U.S.?
That's a huge piece of the puzzle. The book argues these massive inflows, especially from East Asian central banks recycling their trade surpluses and oil exporters their revenues. This created huge demand for safe U.S. assets.
Like treasury bonds.
Exactly. But when the supply of treasuries wasn't enough to meet this global demand for safety, the financial system got creative.
Leading to things like mortgage-backed securities.
Precisely. This safe asset shortage, as some call it, helped fuel demand for assets perceived as safe, like AAA-rated mortgage bonds, even if the underlying loans were becoming riskier. It contributed to lower lending standards and the housing bubble.
So the global savings glut, driven by surpluses elsewhere, directly impacted the U.S. housing market.
That's the argument. The world's excess savings washed ashore in the U.S., helping inflate that bubble. And even after the crash, when U.S. demand was weak, the trade deficit persisted. The U.S. was effectively absorbing the world's excess production and savings.
Acting as the consumer of last resort, in a way. Okay, briefly, what about the international monetary system itself? The dollar's role?
The book touches on the old gold standard, then Bretton Woods after WWII. Bretton Woods eventually broke down U.S. inflation, foreign central banks getting nervous about holding so many dollars they couldn't realistically convert to gold.
And the Triffin dilemma.
Yeah, that's the core tension for a reserve currency issuer. The world needs your currency for trade and reserves, so you have to supply it, often by running deficits. But supplying too much undermines confidence in the currency's value. It's a bind.
You can't satisfy both domestic needs and global demand perfectly.
Right. And the book makes the provocative argument that the dollar's reserve status has actually been more of an exorbitant burden than an exorbitant privilege for the U.S.
A burden? How so?
By essentially forcing the U.S. to absorb these global imbalances, running the deficits needed to supply the world with dollars, which in turn contributes to some of the domestic economic issues we've discussed, like deindustrialization.
Wow, that turns the conventional wisdom on its head. Okay, let's tie this all together. The link between trade wars and class wars, how does the book nail that down?
It really brings it back to that central thesis. These international trade conflicts are, at their root, a symptom of the escalating class conflicts, meaning rising inequality within nations.
And this focus on competitiveness.
It argues that competitiveness has often become a code word for policies that suppress wages and worker power, transferring income upwards within a country.
A race to the bottom, globally.
In effect, yeah. But when many major economies do this, you end up with a global shortage of demand because ordinary workers have less purchasing power, and this fuels the imbalances.
So tariffs are unlikely to fix the root cause.
Probably not, the book suggests, and they might even make things worse by disrupting supply chains and raising costs. The imbalances stem from these deeper distributional issues. It also notes, interestingly, a growing discussion around using capital controls, limiting cross-border money flows as a potential tool.
That's definitely a shift from the free market consensus of recent decades. So if tariffs aren't the answer, what should surplus countries like Germany and China do?
The main prescription is rebalancing internally, shifting their economic focus towards boosting domestic demand, especially household consumption.
How would China do that?
Suggestions include things like reforming the hukou system for real internal mobility and social benefits, building a stronger social safety net so people don't feel they have to save so much for emergencies, strengthening labor rights and unions, and making state-owned enterprises pay out more dividends to the state or citizens. Basically, putting more money and security into the hands of ordinary people.
And for Germany, similar theme.
Similar theme, different specifics. Things like more government investment in infrastructure or education to boost domestic activity, policies to encourage stronger wage growth, strengthening unions, and tackling wealth inequality through, say, inheritance or wealth taxes.
So getting more money circulating within their own economies.
Exactly. The argument is that surplus countries need to spend more and save less, essentially. And the most sustainable way to do that is by empowering their own populations. The solution isn't just about tweaking trade deals, it's about fixing domestic inequality.
That is a really powerful takeaway, that these big international fights are so deeply entangled with how wealth and income are shared or not shared at home.
That's the absolute core of it. You can't effectively resolve the global trade tensions without addressing the underlying class tensions within the key countries involved.
Right. This has definitely given me a new lens to view those trade headlines through. Okay, so as we wrap up, here's something for our listeners to chew on. Given these insights, this deep connection between domestic inequality and international trade conflict, how does that change your understanding of the trade disputes you hear about? And maybe more importantly, what role do you think domestic policies, things happening inside countries, should play in trying to build a more balanced global economy?
That's a great question to mull over. Hopefully this deep dive has sparked some thoughts and maybe even encouraged folks to check out the source. Klein's trade wars are class wars for themselves.
Absolutely. Well, thanks for joining us on this deep dive. We hope it provided some valuable perspective on a really critical global issue.